All right, for today, good topic. I've seen a lot of confusion around the space when it comes into talking about loans, various loan products. How does it work when you are getting a loan in the multifamily space? So how do you get the loans? Where do you find the loan products? What sort of loan products should you be looking for? Today, we are going to go ahead and add resolutions to all those questions, making sure that once you leave here today, you're going to know what loan products are available to you. And you're also going to know when to use those loan products and for what situation. And so I want to make sure I do a pretty thorough job. We got a lot to cover in a short period of time. We'll try to wrap this thing up by 11:30. This is Turkey week. You got family to see, traveling to do. And so we want to go ahead and just hit you over the head with a whole lot of information, making sure that you understand how to get these loans financed, and then we'll hop out of here, right? So hopefully that sounds good to everybody. And to go ahead and hop right into it, let's go ahead and get started. So I'm going to share my screen for those who may be new to this multifamily meetup. I've been doing this for several years. My name is Jason Stubblefield. I have since taken this once face-to-face meetup onto the online world, and so now we do it virtually. But every week we host a meetup where we cover some topic when it comes to multifamily. If you're able to see my screen right now, let's see, Wayne, are you able to see my screen? Justin, can you see the screen? All right, I see heads nodding. So cool. If you see my screen right now, this is our company website. That's snscapitalpartners.com. That's like spelled out Sam, Nancy, Sam, SNS. capitalpartners.com, and you can go to that website. You can find out more about my company, a little bit more about me, see some of the projects that we worked on, just to familiarize yourself with that. Also, if you're interested in hearing about any of our passive investment opportunities, there is an invest tab that you can click on, and if you do that, there's a brief website. This is strange here. All right, like I'm writing on my screen or something. But anyways, if you click on that invest tab, you'll come to this section that says join our community. That puts you on our investor list. So when we have apartment deals that we come out, we raise money from private investors. If you want to see your money work for you while you do absolutely very little, close to nothing, but that's how you can join and hear about the deals that we have. And we got some pretty exciting opportunities going on. So I don't know what's happening to my screen and how it's getting written on. Let's just stop. We're gonna have to solve that some kind of way. I feel like I'm being attacked with this terrorist attack on my Zoom meeting right now. So cool. Let's go ahead and get into loans and various loan products. And I like doing this too. So if you hopped on here, if you're coming in from Facebook, or if you are on Zoom and you showed up like, hey, I want to get this question answered, I want to make sure I don't overlook anyone. So if you could just drop your question, if you got something pressing that you want to know right now, I'll go ahead and see that in the chat window and try to get it addressed. But while that's coming in, I'm going to go ahead and get started, talk about these various loan products. Let me share my screen again, and hopefully this time it doesn't get chicken scratch on it. All right, so commercial loan products, these are going to vary greatly from your residential loans. Just a few things I want to note about commercial properties, right? For the most part, these properties are all, these loan products are all based off of the income of the property. And so a lot of times people that come from single family, maybe they bought a duplex, triplex, whatever, and they're like, my credit's messed up, or I'm, I don't have an 800 credit score, or maybe I'm below 600 or wherever that is. Most of these products in the commercial world, the loan is based off of the property first and the buyer second, right? So what I mean by that is saying they're going to look at the income of that property and say, based on the income that this property produces, this bank feels comfortable making this sort of loan agreement, giving these loan terms based off of that. And they look at the borrower second. So what does that mean? It means that they just look at you, I shouldn't say just, but they're looking to you as a good facilitator, of a good steward over the property. So do you fit the criteria of that loan officer, bank, institution, whatever it is, to be the person who manages this property? All right. And so if you can check both of those boxes, then you can get a loan. It's not necessarily based off credit scores, tax returns, all that other stuff, because in most instances, these loans are not dependent upon you to be able to pay them back, right? You're loaning out multi-million dollars for assets, and usually it's not one person that's going to be able to pay that back. So they look at the property, and you can get what you call a recourse or non-recourse loan. And so what that means is, if it's recourse, that means that they are going to come against you personally for the loan. But in most instances, these commercial loans are non-recourse. And so what that means is that unless you do something that is egregious, right? Unless you're being what they call a bad actor, then they're just going to take the property back. Hey, it didn't work out for whatever reason, and the bank will take possession of the property. Now, you don't want that to happen for a number of reasons. It doesn't help you in your ability to go get more loans, but it doesn't necessarily go against you, your credit score, and you don't have to pay it back. So that's one of the benefits of it. We also did a previous training talk about key principles, and we'll touch on that a little bit. But key principles oftentimes want to sign on non-recourse loans. And when you think about it, just as you being a real estate investor, if you can go and you can buy properties and not have to put your personal credit at risk, right? Why not build a business like that? I think it's one of the safest things that you can do. All right, so let's go ahead and hop in here. I saw something in the chat. I got here late. Where can I sign up to get into deals that you have? Oh yeah, Peter Clark. I will drop that to you. I'll drop that to you in the chat. So let's go ahead and hop in here. So if you are looking for loans, one place that you may look is what you call agency loans. You'll hear this term talked about a lot. Agency is talking about government-backed products, right? So there's some agency. Those agencies are Fannie Mae, Freddie Mac, HUD. There's also Ginnie Mae that's not used as much. But these are your three big players, right? And so the scenario, you want to use one of these agency loans when you're buying a larger property that is stable. And so by large, I mean, usually on the very low end, the loan size needs to be $1 million at least, right? And most times you'll find some lenders that they don't even go down that low, but there are some that do. So if you're buying a loan at $600,000 or $700,000, something like that, it's probably not going to be a good candidate for an agency loan. However, if you're buying something that's larger, it will fit. And so it's also good if you're going to be sitting into a property for a long period of time, meaning that you're going to be in this property for 5 years on the low end, 10 years on the long end, right? And so we'll get into a little bit about why that is. So the pros about doing an agency loans, you're going to get the best interest rate. You're going to get the lowest interest rate that you can find on any product that size coming from one of these agencies. And you're also going to get the best terms. So you have an amortization schedule, and you also have a loan term. So the loan term in the commercial world on the short end will be, well, I mean, it could be as long as like 2 or 3 years, but typical in the agency type of product, it's going to be on the low end 5-year term. Some of them will go out to 10 years, right? So that's your term, but these are going to amortize over a 30-year period, right? So you got 30 years is how the bank is treating the mortgage payments, but you're only going to stick into this thing for the maximum 10 years, and they're going to look for you to do something, whether that's a refinance, whether you sell the property, right? So you also can get interest only, and this interest only product, depending on the type of loan you do, can be up to 5 years. So what's happened lately, you may not be aware of this. And a lot of people had trouble trying to find deals in this market, but if you don't win, I want to drive this point home. If you don't win on the debt side, it's very hard for you to win in any other side. So as you know, multifamily has gotten very competitive. And if somebody is able to buy a property with 5 years of interest only, and you can only get 1 year interest only, 2 years of interest only, whoever can get the better debt terms is going to win that property because they can pay more. right? So knowing the type of debt products is going to be very important for you to do, right? So interest only can go up to 5 years with these agency products. You have to talk to your mortgage officer, whoever you're choosing to work with, to see how many they will be willing to go into for your specific loan for your property, right? And you're also going to get the highest loan to value. And with all these commercial loans, it's going to be based on a loan to value. So there's going to be a determination of how much the property is worth, and then you'll get a certain percentage of that. It could be 70%, 75%, 80%. If you're in real estate, you understand LTV. But in the commercial world, LTV is also determined by your debt service coverage ratio. So if you knew what that is, your debt service coverage ratio is the net operating income, means all your income minus all your expenses, not including the mortgage, right? So we're going to take the mortgage, set it to the side for a second. And now you're just going to say, what's the income? What's my expenses? And then what happens is they take that number and they're going to divide it by your annual debt service. So if you got to pay, $10,000 a month for 12 months, then that would be your NOI would be, divided by that number, right? So just to keep it simple, if you had a property that made $125,000 in net operating income, and then you had a debt service that came in right at $100,000 per year, then you would be at a 1.25 debt service coverage ratio, right? So they're looking to see how much money above the debt payments do you have as free flowing cash flow. And they usually want to see that about 20 to 25% or more above what the debt's going to be. And we discussed how the loans are based off the property first and then the borrower second. So some of the cons of this is going to be the requirements, right? Net worth and liquidity, right? And so that comes into play because you have you're working with agencies. They want to check boxes, right? So you have to have that box checked. So usually the way this goes is that your net worth needs to be equivalent to the size of property that you're buying. You're buying a $10 million property, you need to have $10 million of net worth. And then they want to see liquidity. This can vary, but you may see 9 months of mortgage and interest payments. It may be a year or something like that. So that you're going to want to have some sort of liquidity, and this varies in between lenders. I've seen it vary, but you basically, the way you solve for this, right, is through key principles. So if you're getting started out, which a lot of you may be, you say, hey, I'm trying to buy $5 million property, but I don't have $5 million in net worth. How do I make it happen? Well, you partner with somebody who does have that net worth and liquidity, and then you run the operations, right? Because you have the knowledge and you're willing to put forth the time and effort. So that's one of the cons about working with the agencies, just by getting that meeting the qualifications on that. And then you also have prepayment penalties. So the loan products is good for when you want to stay in long term. These agencies want you to keep the loan long term. They're actually going to sell this on the secondary market, and these people want constant cash flow. So if you break out of the loan, meaning that you sell or you refinance or something like that, there's usually what you call a prepayment penalty, and these can be huge in these properties. So I say this on every piece of real estate that I buy, but you never go into a property without knowing how you're going to get out. And so you think about your exit on this. If you're going to exit earlier, you may want to either understand what that prepayment penalty is, or you may want to choose another product. So also one of the cons of agency loans is just they're going to be non-negotiables. That net worth and liquidity is going to be standard. You're not going to have much wiggle room, and the process can be a little bit lower, right? So that is agency loan. So I want to take a pause right there. Where are we at? Does everybody understand that? I got heads nodding. Do any questions just about agency loans? Let me run over to check how we're doing on Facebook. Are we good there? Be a brief pause. Call this a commercial break. Nothing. All right, cool. I'm gonna keep it rolling then. So if I hear nothing, I'm assuming that y'all are tracking. You got all this information. I made it crystal clear. So cool. Um, Next, we're gonna go into bridge loans, right? So talking about a bridge loan, these are best used for short term, right? And short term value add. So on a bridge loan, you're looking to get out of this product in 1 to 3 years, right? And so this happens where you could talk to a loan officer, mortgage company, and they know that you plan on doing something with this property. So you got some value add. Hey, I'm buying something at $100,000 of NOI. I want to be able to quickly get it to um, $150,000 in NOI, $200,000 in NOI. So I've got a plan. I'm going to implement that plan. And once I do, I'm going to be able to make a lot of money and refinance this loan or sell it to get out. And this is where bridge loans really come into play because they help you do that. Some of the pros of them is that they really have either a low prepayment penalty or in most instances there's no prepayment prepayment penalty. And it's designed for that reason. So you may get only interest, you may only have interest payments, right? So it's typical that you won't pay any principal. They're expecting you to increase the value of the property and get in and out of this loan product, right? Some of the cons of that is that you are typically going to get higher interest rates than what you can get from agency. And the term is shorter, right? So where agency will give you 5 to 10 years, on a bridge product, you may only get 1 to 3 years, right? And that's going to be the typical time on a bridge loan. It's really meant for where you're buying something on day one, and you know that day 180 or day 365 or something is going to be worth a lot more than that. This loan officer, this loan product also believes in you, right? So they're also looking at your pro forma or your estimates of what you're going to do with the property, and they say, all right, we believe that you can implement this plan and give us our money back, so we're going to give you this short-term product to assist you with doing that. All right, so we'll move right along into the local, or what I call a portfolio loan or lender. And so what this is think about agency. These are your big agencies, your bridge. You have bridge products. The local portfolio loan, this is, think about the local bank or that small bank that you may not necessarily have heard of before, but it's local. They sort of know, they know the market that you're in. And so I like using these for areas that I'm buying it. So if you're buying a 20 unit, 30 unit, or whatever it is, and maybe you need to get creative, right? These portfolio loans have the ability to do that because they're not an agency loan. They typically are lending out their own money. And because they're lending out their own money, they have their own standards. And so this is where one of the greatest pros is just your ability to get creative and flexible. And when I say that, they're not going to give you 100%, loan to value or anything like that, but they'll be more flexible with terms. They may be more flexible on your experience. So one of the first syndication deal I did, I bought a property and it was 1.2 million. At that time, my net worth wasn't at 1.2 million. I was waiting on them to come back and tell me that I needed to keep principal. They never did. Right. And this is one of the keys about working with portfolio lenders, is that they have some flexibility in whether they want to loan to you, the borrower, the property, the terms of it. And because they do this, they will allow you to get a little bit more creative. And sometimes they fit into designs of projects where the agency doesn't fit, and it may not be a good candidate for a bridge loan either. So really think about that. They also have low interest rates. And I would say relationships matter. So this is where if you got Billy Bob, the loan officer there, you can strike up a relationship with him, talk about what you want to do, and they can work something out with you. Prepayment penalties are also involved in these type of loans, but you got the ability to negotiate it. So whereas agency lender, they may give you a 10-year pay down prepayment penalty, and you may get the same thing offered from a portfolio lender, and you can just go back to them and negotiate and say, hey, I don't want to do a 10-year step down prepayment penalty. How about we do this? Right. And you'll get a lot more people that are willing to work with you on those type of scenarios to help you get your deal done, because they want your business, right? High loan to values is also pretty typical here. They're going to be in that 70 to 80% typically, and that's going to be based off the debt service coverage ratio as well. The cons to it, it's not going to be the best interest rate. It's not going to be the worst either, but it's not going to be the best. All right, they're not going to kill it, and you may not get the best terms. So agency, they may go out 5 to 10 years. Most local lenders, they may stick to that 5 to 7 year. They're not going to go out as long. They may shorten it up a little bit. And there's prepayment penalties involved here as well. All right. Another thing to note is the amortization on portfolio loans. They typically fall in about 25 years. So you got to think about this, right? The agency is going to give you a lower payment because they're amortizing your loan over 30 years versus a local lender who may do it at 25 years or 20 years. But this is where the negotiation comes into play, where you can go to them and say, hey, I want you to amortize this out over, they may offer you 20. You can say, hey, give me 25 or something like that. So the best thing is the flexibility, but it does have its cons as well. And so now that's the main three that I've used to buy properties with, right? The agency, Fannie Mae, Freddie Mac, bridge loans, and then portfolio lenders. I think that these are also best used for properties that don't necessarily qualify for agency, so they're on the smaller side. But they're still solid, right? You got a solid 12 unit, 8 unit, whatever it is. Those portfolio lenders can really help you out there. So, all right, cool. So we got a question coming in. Let's see, Ryan. He was at Jake and Gino, saying the people bought in the last 2 years on a bridge loan will be in trouble. Why is that? Many people mentioned they wanted to find investors who had bridge loans because they know they will be desperate to sell soon. Ryan, that is a great question. So yes, so while we're in the bridge world, let's go ahead and talk about that. These bridge loans, as I mentioned, you go into a property thinking about how you're going to get out. So what some people did is they bought commercial real estate with bridge loans, and these are short term, but so they had an interest rate, and if they did not buy a interest rate cap, right, that means their interest rate could go to wherever. And so that's actually very good. I need to put this in here as a con, because this is usually can I type? All right. So floating interest rate is usually how these are done. So what is a floating interest rate? That means that you're going to look at either the United States Treasury or SOFR rates, and these are going to be the baseline for where your loan interest is going to be, and it floats. So every month it adjusts depending on what the Fed does. So we had historical, low interest rates for an extended period of time, and a lot of investors were used to it. So they bought deals, and they may or may not have purchased an interest rate cap. If they didn't buy interest rate cap, what that means is that you could have a loan that, remember 8 months ago when you can get a loan at, 3%, and now you can only get a loan at, say, 6%, you're doing good. Well, this happened to them. And so they went from paying payments of whatever it is, paying a interest based off 3%, to now they're paying at 6%, and they now have to sell because of the shorter term. So if you have to sell on a shorter term, well, now what are you going to do? And y'all just looking at this Facebook, this, what am I right to go? So you now have to sell on into a market with a higher interest rate, which is going to drastically reduce the amount of money you can get. So a con of this is the floating interest rate. Just drop that off. That's all right. And then also the fact that you need a purchase a interest rate cap. All right, so let's speak on that for a little bit here. So an interest rate cap, what this means is that when you're buying a bridge product, you're going to say, I'm going to pay the bank or a bank. It's insurance, for lack of a better term. It's insurance to say, I want this insurance to kick in if the rate goes above a certain amount. So stick with our example. You say, I'm buying this property at 3% floating rate interest, is where it is today. If it ever goes above a 4% interest, this is where my interest rate cap comes in. And if the rates go to 4.25, I don't have to worry about it because my rate is now capped at 4%. All right. And I would only buy a bridge. I would only accept a bridge loan if I was buying an interest rate cap because it's too risky. So what they're talking about, Ryan, is that people who bought bridge products and did not buy a interest rate cap, now they're stuck, right? Now they've got mortgage payments that are probably double what they underwrote going into the deal. And it's on a short term. So which means it may be coming, it may be having a balloon payment, and they don't have the ability to sell for more than what they bought it for because those new interest rates have reduced their value. And so, yes, I think this is going to be one of the best buying times that we've seen in a long time, because that is there's a portion of the market that is their reality, right? So good. And yeah, if you're not familiar with the link that Yannick just dropped, that's a great website to check daily floating rates, so you will know where your interest payments are going to be based at on the bridge products. On agency loans and with portfolio lenders, doesn't matter as much. Those are typically going to give you fixed rate interest payments, right? Which would be a pro, right? One of the pros. So fixed rate in your agency. This is going to be floating interest rate, and then the portfolio is also going to give you in the most times fixed rate. Now I'll say this: local lenders and agencies can give you short-term bridge loans, but that usually it's negotiable as well. On the agency, they want it long-term. So typically their bridge product would just be like interest only. And then when you go to refinance it, we want that refinance product too. All right. So we're just saying, we understand your loan. We want the loan on the beginning bridge part, and we want your loan once you take it into something more long-term. Whereas this bridge, they don't necessarily care about what happens afterwards. They just want to get interest and then get the money back. But good points with that. And let's see. Also, so let's talk about hard money for a little bit too, because I know newer investors, they come from single family and think that, hey, let's just go buy apartment complex with hard money. And there is a market for hard money loans in the commercial space, but this is really only good for a property that's just in bad shape, right? Hard money loans are good for bad properties. If you've got a property and say you don't have any financials, remember, right? The bank bases their financing off of the financials of the property. So if you don't have any financials of a property, if the owner's just telling you, hey, I make $10,000 or $20,000 a month, but they can't prove it, many banks will turn you away. Also, if you've got vacancy issues, right? And so you've got a property's 50% vacant, or maybe it's completely vacant. Well, most lenders aren't going to finance those. And that's where hard money loans come into play, because these are loan products. It's typically coming from private investors who understand the product. And they'll say, all right, we'll loan you money to fix up this multifamily complex, but we're going to have the cons. I'll let you higher interest rate, higher fees, and probably one of the lowest loan to values that you can get. It's also going to be short term. So this is basically, you want to take this product out when you know and you feel very confident that you can turn a property around and you can't get other financing on it. And when you think about hard money, how it's used in single family, it's like, hey, let's just do a hard money loan because we can get in, we can get out, right? And they have a very unique place in the single family world, but they're not that unique when it comes to they are unique in the commercial world, but they don't have advantages, right? Because if you can get agency loans, or if you can get a bridge loan, or if you can get a portfolio local lender, why would you take hard money, right? You're not able to commercial properties aren't really built for you to turn over in 6 months or 3 months like hard money, right? These are usually longer term plays because it's big, it's more units, right? So that's where hard money doesn't really play as well. But if you've got that beat up 12 unit, completely vacant, half vacant, no financials, and you feel really confident about it, then a hard money lender could be able to help you out with that. And then finally, I just threw this in here because it's coming up. It's got a fad, it's got a buzz around it, where you have the DSCR loans. And I had to do some investigating just to really see what this was all about. And in my opinion, this is where the commercial world of underwriting has now made its way over into the single family space. So the biggest benefit is that they look at the property first and the borrower second, which is what all the other commercial products do. This is big for single family because if you're going to a lender and they're basing it off of your personal balance sheet, your personal finances, then you run into issues once you get to 2 or 3. I'm sorry, not 2 or 3, but once you get to about 10 single family homes, you start getting issues with banks saying, hey, you got too much exposure. And so they don't want to give you loans as frequently, right? And you end up having to either roll into commercial or something like that. But this DSCR loans, they're just basing it off the property, just like they do in the commercial world. So if you are a single family investor, it allows you to scale your portfolio like that. The cons is I don't really see it. And if anybody has more experience in this than I do, please feel free to correct me. I'm not an expert in this, but I don't really see anything new when it comes to the commercial space. They're just basing it off of the property. You still got to come up with 20% down payment. And so there's really nothing new there, but because it has so much buzz about it and people that were asking and thinking like, hey, now I've got something new, I wanted to include it in here just to provide some understanding and clarity. So, all right. I'm 5 minutes over. I thought I was going to wrap that up at 11:30, but it's all good. Questions on that. Those are the loan products. That is how they work. That's the best use cases for it. Let's see, where are we at? So Houston's like, hey, I need other people's money ASAP. I feel you, my man. We've got training on that too, about how to make that a reality for you. And Houston also says he's got a grand slam deal. So all right. You may want to put some details around that, Houston, while you're there in the chat. If it's commercial property, see what you got going on there. Any other questions or comments? People on the line, on the Zoom, in the Facebook group, how we doing? Are all hearts and minds clear? Okay, I don't see anything. What's the deal with UCC? I'm not certain what you mean with that, Wayne. Can you maybe unmute yourself and ask that question?
Yeah, some lenders like to try, or it's kind of like a lien that you would get personally, but commercially, sometimes they tie you or your company to the property, and they file a UCC against your company. It's like a personal lien. If you ever had a lien filed against you, like if you have a mortgage and you look on your personal credit, you see the mortgage there. That's kind of like a lien. And I've been dealing with one lender. Everything's smooth, and I'm not adverse to it. But I just was wondering if there was anybody that had any experience or any words of advice for that.
Yeah,
I've heard the talk about whether it's recourse or non-recourse, and then just was wondering how the UCC part or the filing of a UCC plays into that.
yeah. So my experience, it doesn't really play into you getting a loan. What will happen is as you're going through the loan process, the title company will perform a UCC search. And this search is to basically see if you, or in most instances, you're gonna buy commercial real estate in an entity. Does that entity have any liens that are outstanding, any liens that are in default? That's that sort of thing. And so it's their way of checking to see if how good of a borrower you are. So again, as I mentioned, right, it's the property first, but the borrower comes in second. If you got a ton of bankruptcies, it's going to be hard for you to get a loan. That UCC search is basically where they look up that information for, but it's not a requirement when you're going in to get a loan. It's more one of the one of the checks and balances that a lender would do as you're getting the loan. Does that make sense?
It does. This particular lender I'm dealing with on a particular property, that's part of what my deal would be with them. They're going to file a UCC for this loan that I'm getting. And, I'm not adverse to it, but I just wanted to see if anybody had any experience with dealing with that. This will be the first time this particular lender, because they're putting up all of the money, and I'm cool with that, and it's going to perform. But just wondering if anybody's got any experience carrying UCCs on their corporation's trade line.
I'm that's different for me, and I'll tell you, I'm not an expert in that. So I mean, we take loans, but it's nothing that really is concerning to me. I know that they can look it up. They can look up my entity and see, bankruptcies, default liens, or whatever. But I think that this lender, from what you're telling me, is just telling you that they're going to file that on your behalf. But I don't know if it's going to come into play as far as having any negative effects on you getting a loan. And as long as you pay that loan back, which you seem pretty confident it perform, then you don't have anything to worry about when somebody else does a UCC search and sees that they put that lien on there, or they're just aware that you borrowed money before. Cool. So any other questions? I think what's the name of the Facebook group that you pulled up, Ryan? It's called the Multifamily Codes. And if you search for that on Facebook and go to groups, you should see it. We'd love to have you be a part of it. So, all right. If nothing else, thank you, ladies and gents. I appreciate you tuning in. I wish everybody a happy Thanksgiving. Oh, I had a message from before. So let me send that. I think that was that you, Ryan, that asked about the investment? Peter. So Peter, if you're still there, I'll drop a link, snscapitalpartners.com. That's Sam, Nancy, Sam, capitalpartners.com. If you click on the invest tab, you can hear about our investment opportunities. You can register there. So we'll be in contact with you after that. And then also, if you want to go there, you can. If you're interested in growing your multifamily portfolio, you want to build this on yourself, then we got something pretty unique. If you're interested in hearing about that, then just reach out to me as well. With that being said, I hope that everyone has a good Thanksgiving, that you enjoy yourself, be the best version of you, because it'll make you the happiest. All right, y'all have a good one. I'll chat with you later.